Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 346th VideoCast podcast for the week ending June 3rd, 2026. Got a lot of amazing stuff to cover today. This is going to be a very special podcast, but as always, family first. We have Mimi and Annabelle there, and this basically was Mimi and Annabelle had their last week of school and end of year class parties. Mimi also had her last week at 6'8 Water Polo Academy. We are so grateful to Tony and Rico Azevedo and all the 6'8 coaches for how they have helped Mimi and helped develop her. She started 6'8 almost 2 years ago, pretty new to the sport of water polo, and she leaves 6'8 being on the USA Water Polo Development National Team. It's been a quick rise for her, and we can't wait to see what her future holds. So thank you to Tony and Rico. And there's Caitlin and Mimi. This was a picture of Spencer Pratt, the guy running for mayor in LA. Looks like he's doing pretty well wearing Vans during an interview, black on black like that. There is Caitlin with Annabelle. And these are my friends, Jason, Jen, William, Jamie. Brooke couldn't join us. I want to thank them. Jason for putting this together, took us on his, he's got a Duffy at his house, and we took the boat to this amazing restaurant called The Dock in Newport. Amazing food, amazing friends, and amazing time. So there's Mimi with Tony, and there's Annabelle on her last day, and it looks like that's that for this week. All right, want to thank the great Liz Clayman for having me on Fox Business, the Clayman Countdown today to discuss markets and a lot more. Jake Mack and Toussaint Campbell for having me on. We're going to listen in here.
And he's talking about how to hedge your portfolio, not just against, Tom, this situation with private credit, which some investors aren't even exposed to, but also against the hyperactivity and enthusiasm over hyperscaler spending. How do you right now hedge your portfolio?
Well, I think you want to get some exposure to defensives, Liz. There's an old proverb, never test the depth of the water with both feet. And right now, as it relates to the AI trade and the tech trade, the semiconductor trade, you're seeing record call buying, record gamma squeeze, record margin debt, and record expectations about earnings growth that you haven't seen since late 2021, right before you had a big tech correction. So I think you got to zig when everyone else is zagging. Everyone's chasing this crowded trade. I think it's time to get into defensives. Defensive sectors, staples, healthcare, et cetera, have fallen to just 16% weight in the S&P, the lowest level going back 26 years to 2000, the last time we had a tech peak. I'm not saying we're at a tech peak. I am saying that what we're going to see happen, the minute there's some type of an agreement with Iran, you're going to go back to what we saw in January and February, which is the everything trade. The moment we went to war, the only trade that worked in the last 8-10 weeks has been tech and semiconductors, because that's the only area where people believe you can get growth even if you get a slowdown and or a recession due to high oil prices, high inflation, and high rates. Once that is taken off the table and expectations go back down around inflation, you're going to see a huge bid in these sectors that have been left for dead. So we want to get some defensive trades, some boring trades that people have ignored for the last 10 to 12 weeks.
And those are Advance Auto Parts and Estee Lauder. We've got less than a minute before the closing bell rings, Tom. What about those two makes them defensive?
Advance Auto Parts, the average car on the road is 14.5 years. This is a turnaround story. They're targeting 7% adjusted margins. Last time they had those type of margins, the stock was $160. So if they can do that by fiscal year 28, you've got a three-bagger from here. We love Advanced Auto Parts on the turnaround story. And Estee Lauder, everyone needs makeup. They're getting out of the retail and standalone stores into the online TikTok shop, Amazon stores. Okay, the company's back to growth, back to margin expansion, back to revenue growth.
Tom, you don't need makeup. This market might need a little powder to get the ugly shine off it at the moment. We are closing at session lows. The Dow now down.
And we're back. And then I had the great pleasure to join David Lynn on the David Lynn Report. It's amazing. David's audience is so engaged, and usually, because I'm bullish 90% of the time, and I've recently turned a little cautious and a little bit of bearish on the AI trade. I think it's a little overheated and overcrowded. And I read his comments bracing for the normal, pushback I get from his audience, and I'm a little worried because they were all in agreement to me because I was a little bit pessimistic for the first time, and they loved it. They ate it up. So I don't know what to make of it, but I think you're going to really enjoy it and get a lot of value. So thanks to David Lynn, and let's listen in here. There's an election coming up. He's going to get out of it one way or another. What you are going to see that morning is oil's going to be down, yields are going to be down, the AI trade is going to be down, and the everything trade, everything else that hasn't been working for the 8 weeks of the war, is going to rip higher.
Do you rotate out of the tech sector, or do you just ride the wave at this point? The S&P 500 just closed at a new record, its 9th straight week of gains, and the longest winning streak since 2023. It's up more than 10% since the Iran war began in February, and yet despite this, Alphabet is selling $80 billion in stock to fund AI, the largest equity raise in U.S. history. And even Berkshire Hathaway is writing a check for $10 billion. Meanwhile, the biggest names in AI are racing to the public markets, with Anthropic filing this week for an IPO at a near $1 trillion valuation ahead of OpenAI and SpaceX IPOs. Even Washington now wants in, with Bernie Sanders proposing this week that the government should take a 50% stake in the largest AI companies. The whole market is now betting on one thing, it seems, the AI build-out, which runs on power and needs natural gas and commodities. So where do you actually put your money when the index is at a new record, the bond market is flashing warnings, and the AI trade is eating all the oxygen? Well, hedge fund manager Thomas Hayes, managing member of Great Hill Capital and host of Hedge Fund Tips, correctly called the rally, and today he's back on the show revealing where he's rotating his money into next. This video is sponsored by Kalshi, the largest prediction market in the United States. Unlike a sportsbook, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below or scan the QR code here and use my code LIN, L-I-N, and new users will get $10 when they trade $10. And right now, traders are predicting that there's a 56% chance that the May jobs numbers will beat the Wall Street consensus of 90,000 jobs. A $50 trade could yield $83 if you're right. Thomas, welcome back to the show. Good to see you.
Great to be with you, David. Thanks for having me.
You're on the show not too long ago. You had called for the other 493 stocks in the S&P 500 to start outperforming, and you were right. An equally weighted index has started outperforming the S&P overall. We'll talk about that in more detail today. Overall, though, the fact that the S&P is at all-time highs again, despite the Iran war having no resolution in sight, despite inflation expectations coming up, and despite the deterioration of consumer strength. We have savings rate deteriorating, and we have consumer debt climbing, and delinquencies on credit cards climbing. What do you make of this rally?
Tale of two cities. There's no question, David. Equal weight was crushing it in January and February, and that was a great call. That's the good news. The bad news is, since the Iran war started out of left field, nothing has worked other than the AI trade. And why is that? It's very simple. If you have increased oil prices, increased inflation expectations, increased yields because expectations of a rate cut goes down, expectations of a rate hike goes up, most of the other sectors cannot thrive in a slow growth environment. That will be the case if Iran doesn't get resolved. And furthermore, what may be the case if Iran doesn't get resolved is an unexpected recession just in time for the election. That is not our base case, but that is the impetus behind the last 8 weeks, where only one part of the market has dramatically outperformed. And really the rest, high quality businesses, have languished because there's uncertainty around the growth expectations with the energy shock and inflation expectations. I will say that this move is driven by earnings growth. Okay, but I think it makes sense, David, for us to look at what is under the hood related to that earnings growth, and what is the composition of that earnings growth that everyone's betting on continuing.
This year is shaping up to be one of the most anticipated IPO years in recent history. Starting with some recent news, Anthropic recently, just yesterday, confidentially files IPO prospectus with SEC. What was the valuation again? Let me just scroll down. I think it's over $1 trillion.
Yeah, $965 billion. So about $1 trillion. Its estimated revenues are $35 billion. So call it 35 times sales relative to SpaceX. That looks like a bargain. If I could say that with a straight face, I don't think so.
Are you buying any of these when they come out?
No. I will say that this speaks exactly to the point that I wanted to open with you, David, which is the earnings growth, the expected 24% this year and 13% next year. That revision upward is largely attributable to not the hyperscalers' operating profits, it's the hyperscalers' other income, meaning they hold stakes in these investments, in Anthropic in particular, in ChatGPT in some cases. Now, Alphabet and Amazon alone reported a combined $53 billion in other incomes. Alphabet was $36.9 billion of the net income was driven by mark-to-market valuation on its equity stakes, which again, largely Anthropic. The gain was more than triple the company's previous quarterly record for non-operating income. So 60% of Alphabet and Amazon's combined net income came from these windfalls, which is simply paper mark-to-markets. This is not their operating improvement. And 34% of the total income across the 5 largest hyperscalers was simply mark-to-market on these holdings, which are trading at between 30 times sales and losing money and 100 times sales and losing money. In the case of SpaceX, the good news is he says he's going to put people on Mars and we're going to be, mining gold from asteroids. The bad news is at 100 times sales, even when that happens 15 years from now, assuming you believe that's going to happen, you're probably paying for it at a $2 trillion valuation, particularly when the rest of the business does $18 billion in revenues and loses, $5 billion of cash per year. So I think that, yes, these valuations, look, my housekeepers asked me on behalf of her husband whether they should buy the SpaceX IPO. I don't even know what to tell them. Because it's like, I want to just say, why don't you just, take the flight to Vegas and put it all on black? Because it's effectively, can 100 times sales, which is ridiculous, become more ridiculous at 200 times sales and still losing money? Yeah, you could get a double. But can 100 times sales get rationalized at, to 5 times sales and you lose 80% of your money? Yes. So the answer to your question is, we're in a little bit of crazy town right now, and you're seeing it with just the standard metrics. Retail call buying at the highest level since 2021 extremes, right before the tech wreck in 2022. Record margin debt provided by broker dealers. Put skew is collapsed. What does that mean in English? It means nobody wants to buy any downside protection. We always say to you, David, the time to buy insurance is before the house is on fire. No one wants to buy insurance. No one believes there's going to be a fire. I'm telling you, insurance is record cheap, and it wouldn't hurt to have a little bit, because when you see companies like Google that can no longer finance their CapEx commitments
Yeah.
through cash flow or through debt issuance, and they now have to dilute their shareholders by $80 billion raising equity at the top. It's something to pay attention to.
Yeah, speaking of, I have this article here. Said in a statement, Capital will fund investments in world-class AI compute infrastructure to meet its unprecedented customer demand. Look, the guys at Google are smarter than me. Let's assume they know what they're doing. They've evaluated, their corporate dev team has made the evaluation that selling stock to fund this is going to generate high ROIC at some point. As a fund manager, you're looking at this and you're thinking, what?
I think I would do 100% exactly what they did. When the ducks are quacking, you feed them. Okay? And that's exactly what they're doing. They're not calculating whether they're going to get a higher than historic return on invested capital off this. What they're calculating is we can raise cheap money because at a, call it inverse, 3% equity yield or wherever they're trading right now, that's cheap capital, and we can always buy it back in on a major correction from cash flow, assuming that they do get the return on invested capital a year to a year and a half out. We're not bearish on the space. We just think there's going to be a better opportunity to buy it in the summer or in the fall. Buy the AI trade. We're probably in the fourth or fifth inning of what will be a 9-inning to overtime innings game. But I think in the short term, all the signs are pointing to, if you're buying this stuff that's up, you're going to be the bag holder. It can become a little bit crazier before the air lets out of the balloon. But I'm telling you, this is going to be a situation where it is buy the rumor, sell the news.
Yeah.
The day you wake up, this was a man-made created war from a tweet. This is going to be a man-made created resolution. And the minute that resolution is tweeted, whether it's a blink, a pullout, a victory, a good deal, a bad deal, it doesn't matter. There's an election coming up. He's going to get out of it one way or another. What you're going to see that morning is oil's going to be down, yields are going to be down, the AI trade is going to be down, and the everything trade, everything else that hasn't been working for the 8 weeks of the war, is going to rip higher because inflation expectations are going to come down, and the expectation of a hike in late 2026 or early 2027 is going to revert back to the expectation of a cut, because Warsh will be able to go out about his business without the fear of those elevated energy prices hitting input costs across all goods and effectively services.
Okay, speaking of what the government wants, we'll come back to the Fed in just a bit. This is from Bernie Sanders, came in last night. Yeah, last night. I will soon be introducing a bill to give the public a 50% ownership stake in the largest AI companies in America. This would guarantee that the trillions created by AI are used to improve the lives of us all and block oligarch decisions that harm the American people. Your reaction?
Looks like Donald Trump and Bernie Sanders have something in common. Donald Trump seems to love equity stakes. Look, that helped us out on Intel. It's funny. When we bought Intel a couple years ago, we have tranches in the high teens. We have tranches in the low 20s. We actually sold it all at $96, $97, close to a five-bagger. It subsequently went to $131. Now it's back closer to $100, probably going to $60 before it goes back to $200. But that was a national security issue. And the government standing them up was not because they liked Lip-Bhutan or because they liked Intel. It's because they had no other option besides Taiwan Semiconductor, and that put us in a very precarious situation relative to China. As far as Bernie Sanders' wish list, I mean, keep dreaming. I don't think that's going to happen. I do think if the U.S. If Google or any of these other companies don't want to raise equity, or they want to raise equity and the U.S. government becomes the source of funds, well, yeah, we're going to take a huge equity stake, but that'll be when they've exhausted all other options. So right now, they've exhausted free cash flow as a source of funding. They've pretty much exhausted the debt markets as a source of funding. So now they're diluting their owners with raising equity at high valuations.
Yeah.
I mean, look, I'm not against that. They were buying back shares at lower rates when they had free cash flow. Now they're no longer buying back shares. I think you got to shift your mind from the AI providers and the AI beneficiaries. And if their thesis on return on invested capital is accurate, and we are going to see that materially in 12 to 18 months, that means real everyday businesses, industrial business, manufacturing businesses are getting value from their services and paying for it. And if they're getting value from their services and paying for it, it means their margins are going up and they're replacing or making efficient some component of labor, some component of intellectual capital. And the play will be in the everything trade margin expansion, while these providers will continue to have margin headwinds because they're using up all their cash to stay ahead with investment for the foreseeable coming years.
There's even a prediction market now. Which companies will the U.S. take a stake in this year? Unusual Machines at 55%, Neros Technologies, IonQ. Some of these have contracts with the military. So not entirely surprised. The notion that the equities themselves will be taken over by the government. I mean, there's, in theory, nothing stopping the government from buying the Google equity raise or anything else, for example, besides maybe legislation. But as an investor, would you want that?
If they're a passive equity investor, look, capital allocators try to get the best return on invested capital, whether they're public sector or private sector. I think that in the case of Intel, whether Trump made the U.S. Treasury $30 billion or $50 billion, I don't know what the exact number is to date, but it's a lot more than they put in. So if they put in 10 and they got 50, and then they've got some warrants on top of it, that's a pretty good return on invested capital for the taxpayer. I'm not a proponent of the government being involved because, particularly if they have contracts with them, it creates conflict of interest, and generally the private sector is better left private. But if they are coming to the U.S. government as a source of funds, if it's, kind of nuclear power companies that maybe can't raise it in the private market, but we do need that form of energy to be competitive in AI and win the AI race. If it's a national security issue, I'm not averse to it as long as it's on pari passu terms with what's available for the public, and the government is not crowding out the public, but rather filling up a deficit of demand from the public to fill those funding needs. So the short answer is leave them out if possible. The long answer is if it's something essential for national security and competitiveness over the long term, and the funding needs can't be met by the private sector, then let them top up and be involved in a passive way and make some money for the taxpayer if it's a good investment. But it needs to be viewed on a discrete thing. If you start funding the Solanas of the world, then that's an incineration of taxpayer money and a cardinal sin.
Okay, let's move on to the Fed and the economy now. There actually is a trading market on jobs numbers. So according to CNBC, traders casually expect that job creation in May will see a slowdown, but still surpass Dow Jones consensus of 90,000. So here it is. Job numbers in May above 90,000, 56% chance that they're going to beat expectations. So I wonder why traders are positive, I guess, on job growth, more so than the street consensus, given that slowdowns are appearing in other sectors. But I'll let you comment on this. And ultimately, I want to know what the Fed's going to do after Kevin Warsh takes the podium.
So two things. I think on the jobs, it's recency bias. The last print was stronger than expected. We'll see if that persists. That's number one. Number two, on the Warsh aspect. And by the way, I have no idea. Take your money, go to Vegas, put it on black. Hedge you win. They write a book about you, tails you lose. Everyone forgets you, and you disappear. So it's just gambling. There's no edge there, and so if there's not an edge, you're best to avoid the game. And sometimes the edge is just intensive research. Mm-hmm. as it relates to Warsh's mandate is to cut. How do you cut in an inflation in an environment where inflation is above trend, largely due to a man-made war? And the answer is you can't. And now, that said, again, all incentives point to the election is coming. He's going to have to resolve it either with a great deal, with bombing them into submission, with pulling out and declaring victory. It doesn't matter. He's going to end it, and the strait is going to open. When that happens, that creates the freeway for Warsh to cut. But he's still cutting into what will be a tail of inflation due to 2, 3, 4 months of elevated energy prices. So he'll be at the same time reducing liquidity on the balance sheet by selling bonds on the open market, sopping up liquidity there, creating liquidity with cuts. And I think that over the next 12 months, assuming the war is not ended, but like some type of fugazi deal or real deal in the next couple of weeks, that gives him the runway by the end of the year to probably do a cut before the end of this year, which is non-consensus. And if you want to, place a high return bet on those gambling poly markets or whatever you're referring to, that's probably the one to do. Everyone's betting on a hike. They'll probably wind up with a cut, and he'll follow through again probably next year as well. And I don't think he'll have much more room to do a lot more than that, regardless of how much liquidity he sops up by selling bonds on the open market. So time will tell.
I'm just curious what the probability is. Next Fed rate hike before 2027 is 38%. Okay, here's my question, though, not on the hike itself, but what happens to treasuries if they do hike. There's already a sell-off. Bonds have climbed the 30 years now up to 5.19%. HSBC calls this the danger zone. At this level, debt starts getting expensive for a lot of different sectors and people.
Yep. That's why small caps aren't working. Look, that's not going to happen. There's not going to be a hike unless the Iran war continues for another month or 2 months, which is not impossible, but it's not probable. I mean, if you're Trump, and everyone knows this, you can turn on, see my housekeeper's husband will probably ask me a question about this. The key is that there's an election coming, and in order for Trump not to get absolutely decimated, or the Republicans not to get decimated, and he becomes a lame duck for the next 2 years fighting in fugazi impeachment hearings, he's got to get this done. And the minute he gets it done, the everything trade takes off, the AI trade cools down. Warsh gets in and starts talking dovish to set expectations around rates. Inflation expectations drop, and the game is on. If he doesn't do that, then the conversation about hikes and debt defaults and consumer destruction and defaults is a valid one, but that would be the most self-destructive thing President Trump could do for a guy who defines his entire net worth by the success of the stock market and his presidency by the success of the stock market. It's a guaranteed way to destroy that, because this kind of short-term AI, it's not a bubble, but there's froth in it in price relative to underlying value in the short term. In the long term, we're in the middle innings, but in the short term, I think some air is going to come out of that balloon just based on positioning. Everyone's crowded to one side of the boat, and this Iran situation is going to be a buy the rumor of a deal, sell the news in terms of that overinflated pocket.
Just on the Iran situation, the Strait of Hormuz is now apparently permanently closed until further notice. Apparently, according to Iran yesterday, who suspended negotiations with the Trump administration. If the Strait of Hormuz is permanently closed, would you as an investor look elsewhere for alpha, given that this no longer moves the news, basically?
If the strait is permanently closed, Democrats will have control of the House and Senate in the fall. Inflation will probably go to 5% by the end of the year. Bond yields will be 10-year yield will probably be 5.5%, 6%. Small caps will be decimated. Unemployment will be starting a recession. Probably have our first quarter of negative GDP growth. So Yeah, I mean, is it possible someone would self-inflict those wounds? I mean, look at Xi Jinping. Like, he had the worst policy for 2.5 years during COVID and destroyed his own industry tech titans. And eventually, once there were 20% of 25-year-olds rioting in the streets, he flipped on his policy overnight, and Alibaba doubled and Tencent doubled, and the game was back on, and consumers' confidence started coming up. But the guy worked 24 hours to destroy himself, and then when he realized he actually might have succeeded, he said, "Wait, I've gone too far," and he flipped the other way. And I don't know when that point is for Trump. I mean, the bottom line is, I think he fools himself by looking at what the indices are doing on a daily basis and views that as a sign of approval when it's super narrow and driven by those companies that are the only companies that could do well in a recessionary, slow growth environment. And that's what the market's pricing, because everything else is not moving. So he's kind of getting faked out by his own strategy, and I think that chicken's going to come home to roost if something doesn't change in relatively short order.
Now, on the yield itself, so yeah, it's risen. Long end of the curve has risen dramatically since March. The deficit level has surpassed $955 billion for the first 7 months of the fiscal year 2026. Now, Thomas, are the bond vigilantes just playing a part in the rising yields, or 10-year yields tracking inflation expectations? Which is it?
I think it's the latter. I mean, who are the bond vigilantes? Like, look, if I think that this guy's going to keep his foot on the pedal with the Iran war, well, inflation's going up. I'm a seller of bonds. If I have an expectation that he's going to be a rational actor and do what's in his self-interest and the self-interest of his constituents, then I'm going to take the other side of that. And I think that's the prudent trade, because if you followed President Trump long enough and you've been around, it's been now 6 years, you kind of know his playbook. He always pulls a rabbit out of the hat at the end. Could this time be different, and could he drive us off the cliff? Of course. Is it probable? No. So you take the other side of the trade and you start buying those things that are out of favor, and you wait for his tweet one day when he says, I won, we got everything we wanted, they have no Navy, they have no Air Force, they have no water, they have no food. We're great, they're bad. And then, you get January and February part 2, where the everything trade rips like bananas. Staples rip, discretionary rips, cyclicals rip, industrials rip, and tech and AI relax.
Real quick on the inflation expectations, that is the consensus view. Inflation is here to stay. The Fed even said that. But let's just challenge that for a second here. If oil stays high, wouldn't that cause demand destruction if people have to allocate more of their capital, personal spending, to oil rather than something else? Isn't that deflationary, or at least in the very least disinflationary for everything else?
The market doesn't care about current inflation. The market cares about inflation expectations. And if the war is wound down, yields are coming down, companies can refinance, housing can come back, which is, by the way, 18% of GDP, which has been left for dead. One thing Buffett did right is they bought Taylor Morrison, which is probably the smartest thing. I'm wondering if that started before Buffett retired, because buying, $10 billion of Google at record high valuation doesn't seem like a Buffett trade. But on the same day, the Taylor Morrison makes a tremendous amount of sense. He's buying something on the expectation that rates are going to normalize. He's taking the rational actor bet and buying in the trough for a long-term huge value play with 72 million millennials in housing formation age. All that has to happen is war has to get done so Warsh can do his job so housing can boom.
Let's finish off on sector allocation. So revisiting your call about equally weighted indices, or at least investing in the other non-Mag 7 stocks, concentration risk since you made that call around the world has only increased. If you take a look at Taiwan, for example, it's just surpassed India, a country of more than 1 billion people in market cap. But if you look deeper, the Taiwan Stock Exchange, 42% of that is just Taiwan Semiconductor. So the notion that 42% of the market index from Taiwan is just one stock, and that logic translates to the U.S. markets, by the way. Do you rotate out of the tech sector, or do you just ride the wave at this point?
You rotate out. because if you look at what was the catalyst for that change, the catalyst for that change was the beginning of the war. So inflation expectations went up, yields went up, and the market said, oh my goodness, the everything trade can't work in a recession. Okay, because if oil prices stay high and yields go up, we're headed to a recession. So everyone is hitting out in this AI trade, which is quote unquote insulated from a recession. Although what we're finding is, guess what? It's not insulated, because now the hyperscalers who were using cash flow to finance their CapEx ran out of cash flow. So then they used debt. But now, because of the war, yields are up. So what are they doing? They're issuing stock at record high valuations, and the public is eating it up. When the ducks are quacking, you feed them, and that's what's happening. It's the same thing Anthropic is doing. The ducks are quacking, they're all racing to the window. SpaceX, the ducks are quacking, they're racing to the window. You want to pay 100 times sale? Sold to you. We're happy to provide. Oh, and by the way, we're going to control the float to only 5% of the company so that we can jam the valuation up. And then as it gets absorbed and pushed into the indices, we're going to dump a lot more stock on the market to the extent that the market can bear it without crashing the price of the stock. So we'll see if they can run that. But look, that's the environment we're in. It's not right. It's not wrong. You don't play the hand you want. You play the hand that you're dealt. And I think the hand right now is super duper attractive. If you take defensive sectors, David, they are at a record low weighting in the S&P 500, going all the way back 25 years. What does that mean? It means staples, it means healthcare, it means utilities. It's dropped from 35% weighting in the S&P down to 16%, below the weighting that it had at the last tech peak, which was the year March 2000, when you couldn't give away a defensive stock, when Barron's was putting on its cover on March 2000. Has Warren Buffett lost his touch? Because while everyone was buying the shiny objects like Ciena, like Micron, like Cisco, all these things that are going parabolic right now, same thing in 2000, he was buying Procter & Gamble, Coca-Cola, defensive stocks. And while everyone subsequently lost 80% of their money in the NASDAQ over the next year and a half to two, Buffett had 3 of his best years ever. While the S&P was down, he was up. All the defensives rallied. All the things that no one wanted during the boom started to fly. And I think we're in a similar environment. The difference here is I don't think we're getting a crash in the NASDAQ. I think we're going to get a breather in that trade. I think it's mid-game intermission.
So what do you like then?
I think you want to get some exposure to defensives. I think, you've got companies like Diageo generates $3 billion of free cash flow. Everyone says that no one wants to drink alcohol. They're deleveraging the business. They sold off a soccer team. New management, Drastic Dave is making cuts. He turned around Tesco in the UK. He's doing the same thing. Every region is growing double digits except the US, which has a tequila problem. They're fixing that with the pre-made drinks. And Diageo is going to return to glory, even though everyone's on GLP-1s. They still like to go out and have a good time. It's about the premiumization, higher quality, less drinking, higher margins. Diageo is the leader in that space. That's a defensive stock. I think if you want to stay in the AI trade, you want to stay in the relative value. I think Alibaba is the cheapest way to play AI globally. I think if you're betting on a weak dollar, you want that emerging markets exposure. I think Baba's the way to play it. You have a lot of optionality. And by the way, the one thing that's not baked into Alibaba's valuation, which you're seeing here in Alphabet and Amazon and the hyperscalers, is they have equity stakes in pretty much every AI startup in China, because when these things were starting up, they said, oh, we need compute, but we have no money. And Alibaba said, no problem. Just give us equity. We'll give you compute. So what you're going to see once that market takes off is the same type of thing you're seeing with Amazon and Alphabet's earnings, where a huge boon to their net income as those paper mark-to-market gains hit is going to benefit Alibaba. I think other defensives like Hormel, that's been a turnaround story. They've raised the dividend every year for 65 years. You get a 6% dividend yield. It grows every single year. Starting to turn the corner, all protein-centric stuff. You saw it in the last quarter's earnings, shot the lights out. They're back to growth. They're back to margin expansion. And stuff like that is going to work. Advanced Auto Parts is another turnaround story. They sold off their Canadian business. They discontinued their unprofitable stores. They're back to growth in all the markets. 75% of their markets, they're number one or number two in auto parts. Average car on the roads, 14 years. The new CEO has turned around the company, and they're back to growth, back to margin expansion. We think this could be a $150 stock. The last time they had operating margins like they're targeting in 27 and 28, it was a $150 stock. It's still trading at 50 or 60 bucks. And by the way, they're opening 35 stores this year, so they're back to growth, back to margin expansion, back to same store sales growth, comps growth. So we like these turnaround and then Get Makeup, another defense. Estee Lauder stock got hammered after COVID, started to recover, doubled off the bottom, pulled back on a deal they were going to do with a perfume company. It wasn't a good deal. So now that that's in the rearview mirror, they continue to execute, and they've moved a lot of their business from the walk-in stores and the malls and the travel to online TikTok shop, Amazon shop. They're growing double digits in those venues, and they're absolutely starting to crush it again. So all these companies, got overstocked, overhyped during COVID peak. Then they had to destock, delever, sell off non-core assets, and now they're all back to growth and margin expansion. No one's paying attention. Stocks are starting to recover, and it's early stages for these. So you just have to be more selective, but buying things, good businesses at great prices versus fair businesses at ridiculous prices.
Final question, I'll let you go, Thomas. So on the rotation out of tech. So people are talking about comparing this era to 2000. You've done that already in this interview. Let's just think about this. Back in 2000, a lot of stocks made no money. Yes, valuations were out of whack, probably out of whack today as well. But back then, we had a situation where there was zero revenue in a lot of these companies, and they were just complete trash, valued at something that was actually good. Now we have a situation where a lot of these companies are probably overvalued, overhyped, but one could argue premiums are assigned to best-in-class companies, which ultimately is where you want to be as an investor. How would you respond to
that? Two ways. Number one, there are similar characteristics of 2000, but I would not compare it to 2000. I think we're mid-game, fourth or fifth inning. I do think we are going to take an intermission break in coming months before the election, and some of these overhyped or overvalued names are going to be less valued. But if you think about the Mag 7 and the hyperscalers, look, what made them the Mag 7 was free cash flow and buybacks. Okay, that has gone away. So they don't have the free cash flow. They are not yet seeing the return on invested capital. I think you are going to see that return on invested capital, but you're not going to see it for 12 or 18 months. And I think in next quarter's earnings call, when everyone realized a lot of this earnings power in Q1 was related to paper gains, in Q2, they're going to more carefully assess operating gains and not see any, because it's just too early to get that return on investment. And I think that's when you're going to get your break in price. But those gains will eventually come. I also think you're going to see a situation where not all the Googles of the world will be able to raise the equity, and the debt markets are going to be a little bit more tricky. And some of them will actually have to blink and pull back on CapEx commitments. And that's when this trade is going to cool, even though it's a temporary pullback, and it will resume. I think that's probably going to be your catalyst to the downside in the near term. And then over the intermediate to long term, for much lower prices, it's still going to be great opportunity. So I don't think this is a 2000 peak. I do think it is a time to be short-term cautious, intermediate-term cautious, long-term still bullish, but from better prices.
Thank you very much, Thomas. Excellent thoughts. Where can we go to follow your work and learn more from Hedge Fund Tips?
Yeah, Hedge Fund Tips with Tom Hayes is the #1 podcast in the hedge fund category, according to FeedSpot. You can find it on YouTube or anywhere you get your podcasts. Hedgefundtips.com is our blog, and we manage money for family offices and ultra-high net worth individuals. You can find out more to see if you're qualified at greathillcapital.com.
Okay, good. Appreciate it, Thomas. Everyone should check out Hedge Fund Tips. Great resource for everybody interested in finance or investors alike. Thank you so much, Thomas. Good to see you again. We'll have you back on again soon. Take care for now.
Thanks for having me.
And thanks for watching. Don't forget to like and subscribe and use my code LIN, L-I-N, when you sign up to Kalshi. Link down below or scan the QR code here. And remember, new users who use my code will get $10 when you trade $10.
And we're back. And this week, we're going to do something extra special. Now that you have context for why only the AI trade is working at the moment, and that's going to change on a dime, and when it changes, it's going to change abruptly. I wanted to cover a bunch of names that we've talked about on this podcast, obviously a bunch of names that we own, and why, people don't understand why when the market's doing this and leaving certain groups out, why it doesn't faze me. And not only does it not faze me, it gets me excited to go in the market and buy more stock of good businesses at great prices when they're completely out of favor, when the mark-to-market is against us. And what I do is I consistently take my mind off the emotions in the headlines and put them on the underlying fundamentals of the business. Because as we always say, in the short term, the market is a voting machine based on emotion. In the long term, it is a weighing machine based on fundamentals. The stock price will always, over time, catch up or catch down based on underlying fundamentals. That you can be sure of. It's like gravity. When you step off the top of a 5-story tall building, out of 20 times, about how many of those times do you go in the downward direction? And the answer is all 20. And it's no different with stocks. You cannot consistently improve the results of the business and the stock price stay down forever. And conversely, you cannot consistently produce mediocre results or losses and have an excessive valuation for long. Sooner or later, the casino catches up on that side of the trade. So let's go through a handful of names here just so you guys can pay attention and get some real value. I like to run into the fire. So when things aren't going most people's way, they hide, they just focus on the things that are working. I like to focus on the problems, solve the problems. The other things take care of themselves. We don't have to spend a lot of time on them. So first things first, for the newer listeners, the number one thing we'd like to do here at Hedge Fund Tips with Tom Hayes, besides wear incredible golf shirts that say Hedge Fund Tips, is zoom out, okay? And what you can see here when we zoom out to the monthly chart, we're looking at Baxter. Okay, and Baxter's been stuck in this $20, $25 range for about a year now. It's not doing anything. So why don't we burden ourselves with the facts? And none of these defensives, healthcare, obviously, the whole healthcare sector, which is why we wanted healthcare exposure to start with, has been out of favor for 4 years and really at a generational buy opportunity when you think about weight in the S&P and what normally happens when there's a little bit of mania in tech. You can't give away defensives. We think that's going to shift pretty rapidly, and these are going to be beneficiaries. But while the price has been going down, what happened? You brought in a turnaround situation. Revenues are starting to re-accelerate over the last few years. As you can see, despite the pump problem, despite the hurricanes, despite all the bullshit that we've had to deal with in this stock for the last 12 months, excuses, acts of God and all this other nonsense. But in the meantime, the free cash flow troughed going all the way back to the first quarter of last year and has been slowly re-accelerating since then. And very few people are paying attention. They're taking out costs to get margins to start to reaccelerate. Revenues are starting to reaccelerate. The only thing that's not yet reaccelerating is price. And we can see this business as being a cyclical business because the same thing happened in 2015, right before the stock went from $30 all the way up to $83 in a couple of years. So when we see the price down and we see revenues reaccelerating, we see cash flow reaccelerating, and they've had no real good news yet other than proper execution after implementing the hard decisions, we buy more. And so that's Baxter, for those of you worrying about Baxter. Crown, Castle, Pure Play, Tower Play. This is rate sensitive. So what have rates been doing because of the Trump war is going up. What's going to happen when Trump decides to end it? Those plays are going to get bid like crazy. Dividend payers, REITs, anything with yield defensives. And look what's happened to free cash flow since they got rid of that small cell fiber business, sold it off. They're using the cash to pay down debt. Now they've got this cash machine with just the Pure Play towers and free cash flows going through the roof. They're going to delever. They're going to buy back stock. Free cash flows at an all-time high. Stock price is still down 50% off the 2022 highs. We love that scenario, and that's an opportunity for us to get more shares when people don't want it, although this one's been going up lately. Diageo, okay? No one's ever going to drink again because they're on Retta, they're on trizepatide, they're on all this stuff, the new Pfizer drug that's going to come, et cetera. So let's just see if no one in the world is drinking. But if you burden yourself with the facts, every single region around the world, Africa grew 16%, Europe grew double digits, Asia grew. The only thing that didn't grow last quarter was the Americas, which was down 9% because of the tequila problem, which they're fixing. But look what they've got. They've got near record, the cash flow, free cash flow is projected to be $3 billion. Revenues, yeah, they've been flattish off a COVID peak when everyone was paid to stay home and drink in 2021 and 2022, and they've still been able to maintain that level of revenues, 20 plus billion. Can't give away the stock, trading at a 12 times multiple, $3 billion of free cash flow. Drastic Dave is in there cutting costs, turned around Tesco. He's going to turn this around as well. Premiumization trend. People are drinking less, but drinking better, higher margin stuff, which helps. Diageo doesn't help Molson Coors. So here we are again. Fundamentals are stabilized and improving. Stock still down more than 50% off its 2022 peak. We love these opportunities. So yeah, it's bounced around from 90 to 70 back to 80. This is going to reaccelerate over the next couple of years. The minute you have the AI trade unwind as a result of the war unwind, you're going to see all these type stocks start to rip like crazy, similar to what we saw in January and February of the year. So, it's just zooming out, burning yourself. That's the fact. This happened to them in 2008, 2009. It happened to them also in 2000, 2001. The last time there was a tech peak, this time will be no different. The stories changed. The fear stays the same. Let's take a look at Disney, which has just been grinding. Bought in the 80s, shot up to 123. Now it's at 100. It's just kind of languishing around. They got a new CEO. They're investing in the highest return on capital businesses. And let's see what's happening here is the cash flow is cranking. At 7, they're expecting to be 10 billion. Revenues are at record highs. Cash flow has reaccelerated off the lows in 2023. New CEOs hitting on all cylinders, and it's dead money until that turns. Estee Lauder, okay, we've covered this one. EL. So yeah, this one's actually kind of rebounded a little bit, but it's early days in the recovery of this. So let's take a look at how's the recovery going and burden ourselves with the facts. Well, free cash flow troughed last year. The stock was down to $47. And since then, it has been reaccelerating as they've gotten out of stores and selling high margin DTC, Amazon store, TikTok shop, direct to consumers. And now they're looking to do deals. The Puig deal wasn't a good deal. They'll get better deals. And you're seeing the implementation of the turnaround plan. Again, same thing happened in 2009, same thing happened in 2001, 2002. It's a cyclical business, got a little bit ahead of itself with travel in 2022. And it's a play on China recovery, and it's a play on a weak dollar because 70% of their sales come from abroad. And then Etsy, okay? Everyone forgot about Etsy, left it for dead. No one wanted it in the 40s. Now it's 67. Still no one wants it. Well, let's see what's happening to the business because this was a $300 stock in 2022. And what has happened since is free cash flow is back up to a record, $711 million at the peak when it was trading at $300 and change. It's $67 now. When it was at $300, it generated its best ever free cash flow, trailing 12 months of $795. The trailing 12 months was $711, and that was a one-off quarter. The quarter before was $676. The quarter after was $694. We're basically at record free cash flow, record revenues. The growth rate has decelerated, but they're still knocking out records, and the stock is still trading at 8 times free cash flow, 8.9 times free cash flow. They've been buying in shares like crazy. All these things are going to come roaring back when people look for safety and value. Right now, they're just looking to chase price. And when that blows up in their face and the casino wins, they will be looking to chase value, and all of these things will begin to rip. Goose. The goose is loose. Baron Trump's girlfriend is all over Instagram wearing Canada Goose. Let's see what's been happening there. Stock is down 72 to 10. So, 963, almost 85%, give or take. And cash flow before and after the record was at 200 million Canadian dollars, 174 million. It's at 149 right now. Stock's down 85%. Record revenues, margins. They're working on the DTC. Margins are trending towards records. Revenues are at records. Free cash flow is fully recovered. Can't give away the stock. There's an overhang because not Boston. All right, if you're wondering about the new shirt, it's because I had the privilege of recording for 2 full hours only to realize that it got cut off after 14 minutes. Apparently, somehow the mute button got pushed. So we're back after dinner to do part 2. And we left off at Goose. So now we're on GXO, zooming out. Let's put it in here. And so GXO, you can see recovering free cash flow, record revenues. Now margins are the next phase of the recovery, but they're hitting on all cylinders. Couldn't give it away at 30, and here we go. So more opportunity. Hormel Foods. Okay, zooming out on stocks that won't work until the war is over. And you've got steady cash flows recovering. It troughed in Q3 of 2025, has been going straight up since. Revenues, obviously the peak was 2022, but we're basically at pari passu levels, and the stock is down 50%. You collect a 6% dividend yield while you wait. Looking under the hood, next example is National Oil Well Varco. No one wanted it at 12. It's up over 20. This is an oil services play. Why is the stock up? Well, it's pretty simple. Opinion follows, price follows cash flow. They turned cash flow positive. They bought in a lot of stock. This is early days in a secular play. The deal will be announced with Iran. This stock will go down because all oil stocks will go down. You'll have a chance to buy it at 16 before it goes to 40 or 50. Next stock is Pfizer. Similar story. Everyone's afraid of the patent cliff, but they've cut a ton of costs. They've invested in CGen. They've got a great cancer franchise, and cash flows recovered off the trough lows in 2024. Margins are starting to reaccelerate. Return on invested capital. You can buy it at a cheap multiple and get paid a dividend while you wait. And then PayPal, of course. PayPal you cannot give away. At 308, everyone wanted the stock. At 42, no one wants the stock. Well, let's see what happened to the business in the meantime, and if what you're paying and what you're getting. So at $300 a share, you were paying for what happened to this? There we go. at $300 a share, you were paying for $4.79 billion in free cash flow and $21 billion in revenue. Now you've got $33 billion of revenue, so 50% more revenue and $5.5 billion of free cash flow. So, 40 some odd percent more free cash flow, 4.7. Well, 15% more free cash flow. So you got, call it 15, 20% more free cash flow, 50% more revenue, and margins have turned up. They troughed in 2024. That was the bear case on the story at 39.54, jumped up to 40.54. Now we're at 41.48. And the share count in the interim, it's not just how much cash flow do they generate, but what percentage of that cash flow do you get? And the answer is there were 1.1 billion shares outstanding back then. There are 8.8 now. So give or take, you get 25% more of what is 15% greater free cash flow. So both the numerator and the denominator, there's less shares of the pie, and the pie got bigger, and the price is 80% cheaper, or 85% cheaper. So this is one of those, once in blue moon opportunities that comes around. So on every red day, we buy more and more and more. People will wake up at some point, maybe next week, maybe next month, maybe next year. It really doesn't matter, because the key is what we're going to talk about in the pod, or I'm going to talk about again, but Peter Lynch said something very good. He said there's 100% correlation between what happens to the company and what happens to the stock. The trick is it doesn't happen over a week or even 6 to 9 months. That's terrific. Sometimes fundamentals get better and the stock goes down. That's what you're looking for. Ladies and gentlemen, tattoo this quote on your buttocks and look in the mirror every morning, and then you don't need to listen to Hedge Fund Tips with Tom Hayes anymore, because you could just remind yourself all that matters is over the long term is a weighing machine based on fundamentals. Price will always catch up or catch down to the underlying business operations. And that's why when we have crazy headlines about man-made wars and ridiculous stuff going on in the world, we just look at how much cash is the business generating, what am I paying for that cash, and what are the expectations and the trajectory. And this trajectory is record revenues, margins are inflecting and recovering in the turnaround story, and I'm paying 85% less than they were paying 6 years ago for more cash flow, more revenues, and re-accelerating growth. This stock will re-rate, and everyone will look back and say, oh, I wish I did. That's fine. You gave me all your stock at 40. Thank you very much. Pizza, Papa John's, similar story. Can't give it away. Obviously, it's doing less well than it was, but not 50% less well than it was. As a matter of fact, revenues are about equal, 2.07 in 2021, 2.05 last year, and cash flow has started to recover. The stock is still down 75%. So I don't know what to tell you, ladies and gentlemen. If you're not putting the pattern together with the divergence between underlying business performance and price and seeing that that's your edge, and then you play the time arbitrage game and you look for the jockey, in this case, the guy who turned around Wendy's for Nelson Peltz and had a multi-bagger there, is now applying the same playbook. He brought in the guy who ran digital for Domino's, who created one of the best performing stocks in the history of humankind. And now they're doing the same exact thing at Papa John's. But you could sell it today because only semiconductor stocks are going up. Although it's interesting that I have to re-record this for 2 hours, because what happened while I was eating dinner, waiting with bated breath to do another 2 hours, we got Broadcom's earnings, and thought that was interesting because if you didn't catch my drift, talking to David Lin yesterday or Liz Clayman today, I talked about Iran, I talked about crowded trades, blah, blah, blah. Well, Broadcom crashes after hours after AI chip revenue misses forecasts. Okay, AI chip revenue forecast misses. The forecast was the problem. AI semiconductor revenue will be $16 billion in the fiscal third quarter, missing analysts' estimates of $17.2 billion. Okay, that's not even close. So the stock, I think, is down 12 or more percent after hours. So this is the beginning stages of these parabolic stocks getting taken out to the woodshed. And that'll create the rotation we're looking for. The Iran thing will get done. Rates will get down. But in the meantime, we just want to burden ourselves with the facts with the businesses that are owned. QXO is another example. Okay. So this is Brad Jacobs' thing. He's done the deals. He's diluted shareholders to raise capital, but he's done it at 30 times EBITDA or whatever it was ridiculous valuation. And then he'll buy it back at 5 or 10 times. And you're starting to see free cash flow start to hum. This is one of those things where you just bet on the jockey and you say, Brad, go do your thing. I'll lay it off when it's a multi-bagger 3 to 5 years out. And you're having one of the best operators in the history of mankind make money for you over the next 5 years. Stanley Black & Decker. Same thing every cycle. Last cycle, down cycle, was 2009 recession. Before that was 2000 and 2001 when you couldn't give away a hammer company because everyone wanted to buy tech companies and .coms. Sounds familiar, but the operating leverage has never changed. How do we know? Because they've been doing this since the 1850s, ladies and gentlemen, 1850s. So Stanley Black & Decker, price is still down, 189. So 2/3, give or take, since a little less than 2/3. It's rebounded off the bottom since the COVID highs. And what's happened? Okay, revenue is back to 2022 levels, 15.2, 15.1 now. Okay, free cash flow has recovered. It went negative in 2022. That's when they started implementing the turnaround, the cost cuts. Gross margins are reaccelerating. They troughed in 2023 at 24%. Now they're back up to 30.63, on their way back to 35%. The operating leverage is huge. Housing recovery hasn't even begun. This is just like Cooper Standard, which is already up a lot. This one is just getting started once the housing comes back, just like once the car volumes came back for Cooper. And they haven't even started because the execution is so good that they're going to earn $10 this cycle instead of $7 at the top of last cycle when it was $146 stock. VF Corp, same story. Okay. You got a stock that you can't give away because it doesn't have a GPU in it. And what's happening? Bracken came in, deleveraged the balance sheet, turned the thing cash flow positive. It's the same thing every cycle. Last one was 2017. And what's happening is he took solvency risk off the table, delevered the balance sheet, share count is down, sold off the non-core assets, and now the business is turning up. We're going to spend a lot of time on that one today. And then, of course, Dent, Sply, Sirona, which we love, which you can't give away. Everyone thinks they're going out of business. They're the leading supplier in the dental business, dental world. Yes, they're a little bit behind on R&D, but the last idiot management cut off all their distribution agreements with Patterson, with Shine, with Atlanta Dent. Long story short, new guy came in. He knows what he's doing. He's put 5 distribution agreements back on, cut the dividend. They've got $122 million of extra free cash flow. They're going to put that into R&D in the short term, start buying back shares, deleverage the balance sheet, and run the playbook. He did it at Globus Medical. He had a multi-bagger in the 10 years. He was chief commercial officer and chief executive officer. And, the name of the game here is that they are cash flow positive. So yeah, they haven't been growing since they did the deal, which they probably shouldn't have done in 2016. And there were all kinds of problems, but they they leaned the two drunks up together. They were doing $4 billion at the peak. Now they're doing $3.7 billion. And he's taken the costs out. They still got 50% gross margins. Share counts down a little bit, and now they've got a new jockey to turn the thing around. It's a GDP growth business. Europe is growing like crazy. US has been down. He's taking the costs out. He's putting in the R&D. He's going to turn this thing. The name of the game with turnarounds is solvency risk and then the jockey. We've got both things in place. We've seen these cycles before in the great financial crisis. Again, in 99, 2000, when you couldn't give away a healthcare stock. We like this exposure, and the experts and competitors in the industry that we've consulted with agree with our analysis. Even if they don't, when we sit at the table, by the time they leave the table, they're buying stock alongside us. So that tells you where sentiment is. Warren Buffett, beware of the investment activity that produces applause. The great moves are usually greeted with yawns. And Seth Klarman, the single greatest edge an investor can have is long-term orientation. Gotta love this, ladies and gentlemen. You know the deal. We do this for clients every week, keep them updated on some of our portfolio positions and how we're thinking about the markets and everything else going on in the portfolio. And we open it up for the general public. For us to keep doing that, we've been doing it for 7 years with great success. Many of you have become clients. We're very grateful for that. A lot of you got it under the wire at the $1 million level in recent weeks. That's changing. The S&C is changing that to 1.5 million on for our July 1st opening. So congratulations who took advantage of that. Many of you started with small accounts, grew them over the years from the ideas on the podcast, and then made enough to become investors. We're very grateful for those. And then a lot of you, now we're starting to get more and more insurance company allocations, bigger family offices, ultra high net worth. So we're super excited on all those fronts. But for us to keep it open to non-clients, we just want to grow is the name of the game. And all we ask every week, if you're getting value, share it with one person you care about that would benefit from this message. And the way many of you have done that is by wearing the merch, the Hedge Fund Tips merch. People ask you, and we are growing, and that's why we keep doing this. And I especially want to thank those that not only buy the merchandise, but the 5% of the people that buy the merchandise, and actually it's less than 5%, send in photos wearing the merchandise so you can be part of the community. And specifically, I want to shout out to this handsome fellow, Mark Shamish, who sent in this studly photo wearing the Hedge Fund Tips t-shirt. I've never seen a guy make a t-shirt look so cool. He's standing in front of the Canada Goose store, looking really good with that embroidered Hedge Fund Tips t-shirt. And shout out to Jennifer, who created a ton more product. I think these new t-shirts are super cool. They're just like the mugs we talked about last week. You can find them, by the way, go to hedgefundtips.com. While you're there, click on terms. This is all opinion, not advice. Consult with your financial advisor before making any decisions. If you don't have one, well, we should talk. But leaving that aside, you click on the hat. It takes you to this fourth wall page. They make all this stuff and ship it. And take a look. She got beware of chasing. So on the front, it says Hedge Fund Tips. On the back, it says beware of chasing shiny objects. Sooner or later, the casino always wins. I think Broadcom shareholders are going to find that out tonight. Banana sideways, you'll be smiling so wide you could eat a banana sideways. Hedge Fund Tips on the front. They don't give away multi-baggers for free is the third one. Be greedy when others are fearful t-shirt. Next one is short-term voting machine, long-term weighing machine t-shirt. Next one, price is what you pay, value is what you get. Opinion follows trend, the normal t-shirt that you saw Mark wearing. And then she did all the hats with the same quotes. So you can get the shiny object hat, you can get the multi-baggers hat, the banana sideways hat, etc. And all the mugs, obviously. And then you click on more to see all the old stuff, the hoodie, which has always been my favorite, the golf shirt, which I was wearing earlier, and whatever, the first 2 hours of recording. So we're excited about that. And then let's get down to some data here. We've got a lot of great stuff here. Consumer staple stocks relative to the S&P, generational buy you haven't seen since the 2000 peak in tech. You definitely want to get some defensive stocks, as we covered with Liz. Same thing with equal weight versus cap weighted. These opportunities come around once every 25 years. You had it in 2000, you had it in the late 60s, and if you took advantage of it, you made a ton of money in both of those instances, just as you are going to now, in our opinion. Here is calls as a percentage of the tape versus puts. You can see record high puts, record high calls, virtually no puts. No one is buying insurance. They think it's going to be blue skies forever. And that's the time you want to be buying insurance. Still got my mug here. This is price is what you pay, value is what you get. Here is the seasonal pattern for the election. So we kind of pulled forward a pullback. Then we peaked out here. We'll see if the normal mid-year weakness in election year kicks in June through the election, and then a big rally into year end. That would be the base case. We will see how that goes. Buyback growth registered at just 4%. That's because hyperscalers don't have the free cash flow, so they hit the debt markets. They ran out of that, and then Google decided, well, debt's getting too expensive. We've run out of free cash flow, so let's just go ahead and dilute our owners by raising $80 billion of equity. If you can't take a joke. So there you go. You see it happening in real time. What we predicted is going to happen. Soon the prices are going to start to reflect that. Next 12 months earnings estimate. People are like, well, how can you be bearish about anything when earnings are now 23% for this year? Well, estimates and reality could be two separate things, as we're seeing with Broadcom. If you look back to late 2021, before the tech correction in 2022, same type of high expectations. Is AI profitable yet? That's the question. Tracking the spend and revenue of frontier AI companies as of last month, May 2026. The answer is no, everyone's broke. What do they mean by everyone's broke? Well, they mean that the orange line is the total spend on, red line is the total spend on AI. Year to date. And the green line is the amount of revenues from AI. So Amazon cumulative spend is $291 million. They've got $22 billion of revenues. Google, $262 billion, $25 billion of revenues year to date. Cumulative spend, $235 billion for Microsoft. Cumulative revenues, $31 billion. Meta, $227 billion of cumulative spend. Revenues year to date, $3 billion for AI. Oracle, $39 billion, $18 billion of revenues, et cetera, et cetera. So you can see that you go down the line, it's not going to last in perpetuity. Consumer confidence, or they're going to dilute the hell out of their owners anyway. So consumer confidence, expecting stock prices higher in the next 12 months. Again, record that you haven't seen since 2021. Small cap growth versus S&P price relative. They're showing an analog from 74 to 81. Small caps were up 10x. So keeping an eye on that as small caps have been breaking out. Cumulative outflow from China since January 26 is $218 billion. So we'll see what that means. The recent data has been that it's going back in. We'll see what happens. Day 100 up 10% year to date. Bulls are smiling. That's from Carson, meaning 8% extra for the rest of the year. I expect a positive year. I just think we're going to go down before we go up. Or at least the overbought sectors are going to go down while everything else gets bid. And because the overbought sectors are 40% of the weight of the S&P, plus the indices could go down with a lot of stuff going up at the same time, aka defensive stuff. This is very important to pay attention to. Energy sector insider buying. You could see in 2020 when we were buying Exxon at $33, all the insiders were buying in the hole with us. And now all the insiders are not buying after you've had this run. Healthcare is the exact opposite. All the insiders are buying when no one wants it, just like they were in 2012 before this huge run. And that's what we're doing right alongside them, buying healthcare when no one wants it, just as we were buying energy when it turned negative in 2020 during COVID. U.S. household holdings of equities as a percentage of financial assets, record highs, not seen since 2000 and higher than 2000. My guess is too much of this is crowded into the AI trade, I think that's going to back off pretty quickly and hurt a lot of people. I don't know who this is from. I put this on here, and my bad, I did not put the source. Jeff knows to always put the source and whatever. I just came across it in the middle of the night. And this is very interesting. This is the semiconductor parabolic move today versus 1998 to 2000. So it's comparing 2022 to 2026 versus 1996 to 2000. And the interesting thing is it's the exact same amount of move. We went from 2,000 to 13,000 right now. They went from 200 to 1,300 right now. So if you think that this is should go longer than the end of the semiconductor parabolic move in 2000, then keep betting on it. But I would bet that Intel is 60 before it's 200, if it's ever 200. I think we got paid when we took it off at 96 and 97. I think we got paid for a lot of good things that are going to be happening over the next 3 years, but we got paid up front and we took it. At the same time, the NVIDIA H200 pricing is down from $7 down to $4.11 over the last month. So that's something to keep an eye on. Only Amazon clears a positive return under the most generous assumptions. So you can see here implied return on a hyperscaler AI investment from 2025 to 2030, assuming zero cost. Implied return on investment. This is from Financial Times via Panmure Liberum. Microsoft negative 9.2%, Alphabet negative 15.7%, Amazon 7.2 positive, Meta negative 28.8, Oracle negative 35.6. This is from All-Star Charts showing SPX to VIX ratio. The last time it got this elevated were before short-term corrections, whether it was in, so you can just look at all these instances going all the way back 2-3 years when the S&P is outperforming the VIX by that magnitude. What matters today? Savings rate, okay, covered that. Sentiment on rates and the outlook have been an extreme at every rate pivot point. I'd be a buyer of TLT here. Rates are going lower, not higher. The Iran thing has to get resolved, and it's going to be a violent rotation into the everything trade. Cumulative S&P return contribution since March 30th. You can see here it's been all tech and AI. Why? Because that's the only thing that can grow, which we covered with Liz. China's e-commerce giants, generational buy, we agree. Ant Finance, Alibaba, this is what we were talking about, all their private investments that no one's accounting for. Corporate profits as a percentage of GDP accelerated here. Weight of semiconductors at a new record, 18% now versus 9% at the 2000 peak. So you can believe that this cyclical business is going to be secular, but I can tell you that there are going to be bottlenecks. There are going to be challenges along the way. And the Chinese, by the way, are out already putting out a lot of this memory stuff, and you're starting to see that trickle in. Retail cash activity, call options at record highs. You know what happens next. Same thing in 2021. Token consumption on top 9 models through Open Router AI API calls. Tokens are through the roof, which is why a lot of businesses are realizing how expensive it is to run this, and deciding that in some cases, it's cheaper to keep humans. This just points to the weak breadth of the recent move. Long-term growth expectations are at highest level since early 2022, right before the rollover, and then you got to go back to the March 2000 peak. So look, it doesn't mean we're going to have a crash. I think this crowded trade is going to get unwound in the short term, but I do think we're middle innings, and we'll be looking for opportunities among the rubble in coming months. So that's that. Biggest gains. Divergence between QQQ and KWeb. KWeb's the opportunity. Earnings growth outlook, same thing, peaked in 2021, before that 2000. This is going to wind up being fugazi as it was in 2021 and in 2000. Retail bullish positioning nears extreme on call options. You know what happens. They're not getting paid. I guarantee you they are not getting paid. The dealers are going to make that money. They're right now in a gamma squeeze, having to buy all the stock because they sold all the premium to these idiots at the top who are going to lose all their money. Put skew, again, broken. No one wants protection at the exact time they should be buying it. We've got an amazing setup for our clients in the most crowded trades, hedging that out when that unwinds in the next few months. Financials positioning non-existent. Car sales better than expected. Car relations lowest level since 2018. Short interest starting to creep up. This is very important. This is from Bespoke. This shows relative strength versus the S&P. Every single sector is down since the war, except for technology. 2 months from now, you're going to come back. This is the exact opposite. Technology is going to be the only red arrow. Everything else is going to be green relative to the S&P. Let's see here. Business applications going up. That's a good thing. That will be a huge beneficiary because of AI. Consumer confidence, stock market expectation next 12 months, of course, super high right before. It shouldn't be. So that is our key data points for right now. Okay, picking back up here, we've got first off, call buying surges to 2021 meme stock era extremes. This just out an hour ago. I talked about it 6 hours ago on Clayman. Think AMC and GameStop on these semiconductor stocks, just in time for Broadcom to miss. Sales guidance was 16 billion versus 17.2. CEO Hock Tan was asked whether he sees productivity gains from AI agents. His answer, quote unquote, no. Same week as IBM comments that 1 to 2 trillion sales needed. He says, Hock Tan was asked whether he sees productivity gains from AI agents. His answer was no. Buy shovels, they said. Okay, so the forecast was the problem, 16 versus 17. Also, their EBITDA guidance of 68% was missed the street at 69.1. Forecast miss is concerning. Broadcom has signed and expanded long-term deals with companies like Google, Anthropic, and Meta, but questions remain as to how much revenue will be recognized each quarter as opposed to being accounted for in a multi-year backlog. Investors were also disappointed after the company kept its full-year AI target at 10 gigawatts in 2027 and 100 billion in chip sales for the full year instead of boosting guidance as it had in prior quarters. The pressure was also margin-related as Google TPU growth generating lower margins than networking and software. Hock Tan has tied the company's fortunes to AI gear, betting on rapid expansion of data centers and other infrastructure, while NVIDIA remains the dominant maker of AI accelerators. Broadcom has positioned itself as a key alternative. In hopes of boosting its operational leverage, Broadcom has been taking a bigger role helping finance the purchase of chips. As Bloomberg reported over the weekend, Apollo and Blackstone are working on a roughly $36 billion debt financing deal to help Anthropic pay for its Google chips that Broadcom helped to develop. Broadcom is backstopping payments on the largest portions of the transaction, Bloomberg reported. So we have yet another circular deal. Broadcom is funding the SPV that will allow Anthropic to pay Google for Broadcom chips. You can see why the entire AI industry is now so careful about even the smallest drawdown. If even the smallest cracks appear, questions will once again start swirling about risk and ROI. And now that there are over 600 billion in private credit SPV backstopping future growth. By the way, you saw record redemptions from private credit today. The entire house of cards could come crashing down. Against that backdrop, the latest report failed to satisfy investors, with the stock crashing 12% in late trading, erasing all the recent gamma squeeze gains orchestrated by market makers to set the stage for the coming mega IPOs. It was up 38% this year through the close. Those gains have been cut in half after the results. So that's that. Another article, 662 billion reasons to worry. Moody's raises AI data center funding fears as Apollo shops huge Anthropic debt deal. Unless you've been living under the rock, you know that explosive growth of artificial intelligence is fueling massive infrastructure build out. Blah, blah, blah. Torrance Slocked. Working capital expenditure on data centers estimated at roughly $646 billion, 2% of GDP. Slock noted this is roughly equivalent to GDP of Singapore, Sweden, Argentina. Defense spending 2025, meanwhile, was around $917 billion. As Moody's warned this week, the aggressive financing structures supporting this explosive growth are creating significant systemic risks that could ripple across global credit markets and the broader economy. The most recent example of this build-out and its coincident debt funding is the $36 billion debt financing package currently being shopped by Apollo Global Management and Blackstone to enable Anthropic's large-scale acquisition of Google's custom TPU chips. As Bloomberg reports, this complex high-leverage deal, partially backed by Broadcom, underscores how private equity and specialized financiers are channeling enormous amounts of capital into AI hardware and data centers through layered debt instruments. The move could mark one of the largest ever private credit deals and also the biggest chip financing debt transaction. It aims to tap Broadcom's credit quality to provide computing power access to Anthropic, which just eclipsed rival OpenAI in valuation, and its ecosystem has been dramatically outperforming. While such deals accelerate AI capacity, they also concentrate risk. More concerning is the scale of the hidden liabilities across the industry. According to Moody's ratings, the 5 major U.S. hyperscalers, Amazon, Meta, Alphabet, Microsoft, and Oracle, have accumulated approximately $662 billion in future data center lease commitments that have not yet commenced. Combined with other commitments, the total undiscounted future lease exposure reaches $969 billion. To put the scale of this hidden obligation into perspective, Moody's accounting analysts David Gonzalez and Alastair Drake calculated that the unrecorded $662 billion is equivalent to 113% of these 5 hyperscalers' most recent adjusted debt. These obligations remained entirely off balance sheet under current accounting rules, despite representing binding long-term liabilities. But as Gonzalez told Fortune in a statement, that it's not as if these hyperscalers have avoided a liability through structuring, characterized the $662 billion at issue as, quote, yet to be on the balance sheet rather than missing. More accurately, he added, they have not yet received the services to trigger this liability as of the time, but they will. This accounting deferral masks the true leverage in the system. As these leases activated over the next decade, they will migrate onto balance sheets, potentially weakening credit profiles, elevating leverage ratios, and increasing refinancing pressures at a time, by the way, when they've run out of refinancing, that they're issuing $80 billion of debt in the case of Google. Moody's is basically highlighting that the current funding model, reliant on massive off-balance sheet debt and complex private financing, builds hidden vulnerabilities into the financial system. So that's that. Another thing I found interesting was this letter from a billionaire's portfolio. It says, we talked yesterday about Jensen Huang's presentation showing production of software going vertical over the next few months, $9 trillion of productivity from $3 trillion of salaries. And we ended by looking at the San Francisco Fed's report on total factor productivity, which decelerated in the first quarter to 0.60%, 60 basis points. Let's talk about that gap. Jensen focused on AI usage. For the past year, token consumption has been celebrated on Silicon Valley. Big companies, particularly big tech, took a clear strategic position, pressed the gas pedal on AI to the floor, and burned tokens. They turned usage into a scoreboard. Companies like Uber, Meta, and Amazon ranked engineering teams by token consumption. The more they celebrated. What's the problem? High token count doesn't tell you a lot got done. It tells you a lot got used. When people reward people for consumption, the meter just runs. But if you don't necessarily solve problems, ship products, reduce costs, or create value, and the tell at this point is in the recent behaviors of these same companies, they are cutting back on or setting limits on usage. And by the way, as we referenced, finding out that in many cases it's cheaper to use humans instead. The Fed's Q1 number on total factor productivity reveals that story. It decelerated, not accelerated. It doesn't confirm a productivity boom at least yet, but it's early. We've seen the investment. We've seen the hesitation at the enterprise level. Now we've seen aggressive adoption and experimentation. We are seeing some waste. Now maybe some refinement, discipline, and productivity gains. With all the above in mind, we get the jobs report on Friday. Is AI building phase increasing labor demand, or is AI visibly replacing labor? If is AI proving useful as Jensen positioned it, or is it getting used a lot? To be determined. Okay, next. AI cloud brings full stack ecosystem to global consumers for the agentic era. Let's go through some of these reads. Alibaba elevates tech chief Wu Zheming to elite committee as AI push ramps up. 12 consecutive quarters of 100% triple-digit revenue growth on AI. Only quote-unquote hyperscaler doing it in the world. How Kelly Ortberg is rebuilding Boeing from the inside out. China does not matter for Boeing. This does. Read that at Barron's. Advanced Auto Parts nears the finish line on distribution center consolidation strategy. Amen. Hallelujah. May auto demand stronger than expectations. Deutsche Bank says Cooper Standard named a 2025 Supplier of the Year by General Motors. Berkshire is convinced the American dream of home ownership will stay alive. We agree. Think that was a smart deal. Taylor Morrison think the $10 billion of Google at the top was a dumb deal. Buffett would have never done that. QXO $6 billion debt sale for top build deal is fully underway. U.S. construction spending picked up in April. Estee Lauder still open to acquisitions they've been doing since 1946. Pfizer inks up to $10.5 billion deal with Chinese Innovalent. Here's Vogue talking about Timberland's beefed up boat shoes go beyond the yacht club. They're on a run with these. We're going to cover that as well. Vans, sneakers, Dodgers logos. This is Vogue, how Spencer Pratt is leveraging LA iconography for his mayoral campaign. Alphabet's $85 billion stock deal could open the faucet for big tech offerings. They're all going to run to the window at the same time. America and dilute the hell out of their owners. America's data center build out is falling way behind schedule. Google, which is raising a fresh $85 billion, has a strategy for getting around the biggest bottleneck. Corporate America is starting to ration AI as costs skyrocket. Executives are scrambling to track returns on AI investments as the bill for massive computing needs comes due. Strong corporate earnings may not be what they appear. We covered that on the David Lynn show. Iran deal would risk AI stock rotation that weighs on the S&P 500. Morgan Stanley turns more positive on cyclicals as earning momentum broadens. Kevin Warsh wants the Fed to think about inflation differently. U.S. proposes fresh tariffs on 60 economies over forced labor trade practices. Trump back at it. And our article of the week. Can't wait to read this one out for the second time today. Recipe for a comeback stock market and sentiment results. VF Corp update for newer readers. Here's a quick overview of the key drivers behind our thesis on VF Corp, a global apparel and footwear leader with a portfolio of iconic brands, now firmly in the growth phase of its turnaround with significant operating leverage ahead. So you can go through this at hedgefundtips.com. It's been nearly 3 years since Bracken Darrell took the helm at VF Corp, and he and his team have delivered on nearly every major objective outlined from day one. The turnaround was always a two-phase job, with the first phase centered on unglamorous but necessary work of reducing costs and repairing over-leveraged balance sheet. On the cost side, management has removed more than $225 million of structural SG&A from the business since fiscal year 24. Those savings are now fully embedded in the run rate, helping expand operating margins by 220 basis points to 7%, while keeping the company on track to achieve its 10% operating margin exit rate by target fiscal year 28. On the balance sheet, the divestitures of Supreme at $1.5 billion and Dickies at $600 million helped reduce net debt, excluding lease liabilities, from $5.8 billion 3 years ago to $2.7 billion today. Leverage has fallen from 5.1 times to 3.1 times, putting any lingering solvency concerns firmly to bed and leaving VF Corp on track to nearly reach its 2.5 times leverage target a full year ahead of schedule. With both of those boxes now checked, the restructuring chapter of the turnaround is now in the rear view mirror, shifting the focus to something far more exciting: growth. Fiscal year 26 marked the first year of revenue growth in 3 years, with revenue up 4%, while 70% of the portfolio is now growing compared to just 43% in fiscal year 24. Starting with the North Face, the brand continues to fire on all cylinders, growing 12% to $935 million in Q4 and 8% to $4 billion for the full year. Management still sees the brand as only scratching the surface for its long-term potential, reiterating its target of doubling the business over time with multiple levers to still pull: category expansion, market share gains, and further elevation into premium price points. The brand also recently landed a high-profile 8-year partnership with the U.S. Ski and Snowboard, outfitting America's top winter athletes across the next 2 Olympic cycles. Timberland, meanwhile, is finally beginning to move beyond its biggest challenge, becoming more than just the yellow boot. The brand posted its 6th consecutive quarter of growth, with revenue increasing 8% to $405 million in Q4 and 8% to $1.74 billion for the full year. Despite its iconic status, Timberland remains significantly underpenetrated. Management is expanding distribution through an accelerated DTC push, with the U.S. full-price store base now at 11 locations and more planned for fiscal year 27. Combined with growing traction in the boot shoe platform and a comprehensive apparel reset arriving this fall, the brand appears to have the right pieces in place to finally break out of the $1.7 billion revenue range, where it has largely been stuck since VF acquired it in 2011. Then there's Altra, the #1 trail running shoe brand in the U.S. and a breakout star that management has only recently begun talking about. Revenue growth of 45% in Q4, marking a 5th consecutive quarter of double-digit growth, while full-year sales reached $270 million, up from just $50 million when VF acquired the brand in 2018. With brand awareness still below 10% in the US and even lower internationally, Altra is still in the early innings of what management sees as a $1 billion plus opportunity. And last but certainly not least, Vans, the final domino in this turnaround. While fiscal year 26 marked Vans' 4th consecutive year of revenue decline, with sales falling 9%, it also contained what will likely prove to be the most important development in the entire VF story: an inflection in the Americas. America's DTC returned to growth for the first time in nearly 4 years during Q4, increasing 5% and snapping a streak of 14 consecutive quarterly declines. The importance of this inflection cannot be overstated. The Americas account for more than half of total Vans revenue, while America's DTC alone represents 40% of the global business. Where the Americas go, Vans goes, serving as a leading indicator with a trickle-down effect that flows into wholesale and eventually the rest of the world. There's no question that brand heat is building in the Americas. The Authentic franchise grew more than 80% in Q4. Slip-ons returned to growth. Apparel is gaining traction. And while certainly not encouraged, there have even been reports of fights breaking out at Vans stores over limited edition product releases. For a brand that lost its cultural relevance and saw revenue decline from a peak of $4.2 billion to $2.1 billion today, fights breaking out over the new product is not the worst problem to have. Here's the headline: off the wall, near riot erupts at Midtown Vans sneaker event. We showed pictures in previous weeks. While management guided for another year of declines at Vans in 27, improving to just a fiscal year 27, improving to just a mid-single digit decline, we would not be surprised to see upside to that outlook. And this is an under-promise, over-deliver management team that likely wants to see how back to school and the holiday season play out before getting out over its skis. That said, with the Americas already turning and expected to grow again in fiscal year 27, along with a number of catalysts on the horizon, including an expanded Warped Tour, culture-led marketing initiatives, high-profile collaborations, continued traction in premium product launches, and positive search trends, we expect the Vans inflection to arrive sooner than the market is currently bracing for. If you drive past the headquarters in Irvine, you see the Warped Tour advertised all over the building. It's super cool. Put all the momentum across the individual brands together, and what you have is a portfolio of iconic brands that is just beginning to return to growth mode with ambitions and in Bracken Darrell's own words that go far beyond low single-digit growth. Quote, I want to get this back to where it's growing, mid-single digits, then growing high single digits, or even touching double digits sometimes in a sustainable way. 3 years ago, the investment debate centered on whether VF could stabilize the business and repair the balance sheet. Today, the debate has shifted to growth, and growth Bracken is just getting started. So that's that. You can go to hedgefundtips.com and go through all the key 10 points at your leisure. Should read the full article and the transcript. We've highlighted the most important parts. And now we're going to get to Papa John's pizza story. Here's the overview of our original thesis on Papa John's for the newer readers. Global leader in the pizza QSR category, where a proven operator is driving back to basics turnaround after years of self-inflicted missteps. Papa John's faced continued pressure in Q1 as a cautious consumer and an aggressively promotional QSR backdrop weighed on North American results. North America comps fell 6.4% year on year, missing expectations of negative 4.6% and pulling North American system-wide sales to $868 million. International continued its run of outperformance with comps up plus 3.6% to mark a sixth straight quarter of positive growth, while segment system-wide sales increased 6% to $333.4 million. These strong results overseas weren't enough to offset weaknesses at home, with international accounting for only 15% of total adjusted EBITDA. As a result, adjusted EBITDA fell 3.7% to $47.8 million, missing consensus expectations of $51.2 million. At this stage of a turnaround, ugly headline numbers like those seen in the first quarter are to be expected. At the end of the day, we are buying a stock that is down 70% from its all-time highs, an entry point that more than compensates us for the 3 to 9% decline in global comps seen during the quarter. What matters to us is not a single quarter's results, but what management is doing to fix the business over the long term. On that front, the picture is far more encouraging than the headline suggests, with the right ingredients in place, pun intended, to drive a turnaround over the next few years and reward us handsomely in the process. A key part of the turnaround playbook is Rebuilt's innovation pipeline that is finally putting compelling products back on the menu and getting traffic in the door. Leading that charge is Pan Pizza, the first major launch of 2026 and the brand's first new crust platform in nearly a decade. Following its nationwide rollout in late January, Pan continues to track ahead of expectations, supported by strong repurchase rates. Management is building awareness and extending the rollout into priority international markets as a broader part of a broader push toward premiumization and ultimately a Michelin star ambition. We've ordered the Pan Pizza a lot. My girls love it. It's really good. I would strongly urge you to get it with pepperoni, even if you're not a pepperoni person. It's delicious. It's kind of like this crunchy cheese around the crust. It's good. Papa John's desperate to get a Michelin star for its fast food pizza and changed the recipe to make that happen. In late March, the company launched oven-toasted sandwiches, opening an entirely new category aimed at an increasing participation across both day parts. Early results have been encouraging, with the sandwiches generating strong incremental sales and already outselling Papa Diaz, a now discontinued rhythm breaker, alongside Papa Bites that once clogged the make line with operational complexity. Management also announced that its cult favorite garlic sauce will hit retail shelves nationwide this summer. Over 7,500 distribution points, including Walmart, Kroger, Albertsons, Safeway, and H-E-B. The move creates yet another incremental revenue stream while extending brand awareness beyond the four walls of the restaurant. At the same time, Papa John's is leading into high-profile partnerships to build momentum, headlined by a recently announced collaboration with Disney and Pixar tied to the upcoming release of Toy Story 5, its biggest cultural push yet. The campaign spans 43 markets and includes themed personal pizzas, custom packaging, and 4 Pizza Planet experiences, all built around a new 8-inch personal pizza platform that management views as a strong customer acquisition vehicle going forward. As longtime readers know, we also own Disney, which makes this a nice overlap across our two holdings. Below is a transcript of an interview with Papa John's CMO, Jenna Bromberg, who discusses the partnership and, just as importantly, the return of local marketing co-ops. These co-ops, these are advertising co-ops, were instrumental in building the Papa John's brand in the first place and were later phased out in favor of a national marketing strategy under prior management and are now being stood back up. 50% of the U.S. system is supported by local co-ops across 50-plus markets, which we view as one of the more underappreciated drivers of the turnaround. How's Papa John's making the most of the partnership with Disney and Pixar? Jenna, what's cool about this one is we are activating globally. This isn't just a North America program. For the first time ever, we're doing this program in over 40 countries around the world. We're going to have 3 illustrated collectible boxes with some Toy Story characters. And we have 3 character-inspired recipes on our menu that are really special. Above that, we have collectibles in certain markets. Our TV spot was animated by Pixar. You'll see some of the characters show up in a Papa John's kitchen and play around with some of our better ingredients. Finally, our Toy Story in-app game is just for our Papa Rewards members. Using first-party data in your marketing efforts, loyalty has been a significant engine for us for years. We are actually an innovator and a pioneer in the space. We were one of the first QSR brands with the loyalty program. Find that our loyalty members are more engaged, obviously, than our non-loyalty. This year, we have started to do much more personalization, giving members different offers based on their tastes and preferences. A couple weeks ago, we launched Lou AI, which is our AI-powered ordering agency. It's a fast ordering experience, and the best part is you can do it totally hands-free and just speak your order. It reminds me of Wedding Crashers when Will Ferrell goes, "Mom, meatloaf." So now you can just talk to Lou on your phone. "Lou, pizza," and it'll show up at your door. Google's helped us develop the AI platform, and we're really pleased with some of the early results with the Google partnership. There's much more around the corner to come from that, but this was our first big project. To differentiate Papa John's value in a space competitors also market around, quote, better ingredients, better pizza. Promise has been a huge part of the value equation for a long time. Last couple of years, continue to promote our 6 Papa pairings, marketing co-ops. Absolutely right. The other piece that the local co-ops are enabling is better coordination between our national marketing programs and our local marketing, whether that's how offers come to life or on third-party platforms like DoorDash and Uber Eats, or how local carryout offer might be able to complement something like a national innovation message. It's really allowed much better and more cohesive total marketing plans to come together between national and local. Each of these initiatives is doing exactly what management set out to do: improving mix, driving add-ons, and expanding the addressable market. Taken together, they form a combination of top-line catalysts that we believe can support a strong recovery in the back half and beyond. In the meantime, management is undertaking the serious and long overdue heavy lifting required to improve profitability. The company is executing a plan to remove $90 million of costs from the business through supply chain savings, $60 million, and G&A reductions of $30 million by fiscal year 28, a program expected to drive 200 basis points of four-wall EBITDA margin expansion over the medium term. Pizza is also taking a page from the same playbook that successfully turned around international operations, closing 300 underperforming North American locations by the end of 2027. These units generate AUVs below $600K compared to a top half fleet average of $1.4 million, with many operating at negative four-wall EBITDA. Lastly, management is accelerating refinancing activity as it works toward reducing company ownership to the mid-single digits of the North American system, a shift that leaves Papa John's with more asset-light, higher free cash flow model. Even after closing the 85 restaurant transaction in Q4, the domestic company-owned fleet still accounts for 13.1% of North American system as of Q1. Management continues to see a strong pipeline of buyers at attractive multiples, including a 29-unit transaction in Southeast expected to close by Q3. None of this work is flashy or glamorous. It's just operational blocking and tackling, the type of work a turnaround at this stage requires, and what you would expect from a management team focused on long-term value creation rather than the next headline. That level of execution and focus is also not consistent with the management team looking to sell the company at the bottom of the cycle, despite steady drumbeat of reports surrounding Earth Capital's offer at $47 per share. These bottom of the cycle bids are familiar territory for us and for Papa John's. We've seen the same pattern of lowball offers emerge across several early stage turnarounds that we've held, whether it was Goose, GXO, PayPal, or now Pizza. In each case, our view has been the same. There is far more value in executing the turnaround successfully than in accepting an in-the-hole buyout that robs shareholders of upside ahead. We'd much rather sit back, give management time to execute, and lock in a 5.8% forward dividend yield, the highest available to investors at any point in Pizza's operating history, all supported by a balance sheet with no major maturities until the end of the decade. Sooner or later, the market will come back to a simple truth. Americans love pizza. That isn't going anywhere, and neither are we. So that's that. 10 key points, along with the earnings call transcript, highlighted key parts at hedgefundtips.com. Fear and Greed at Greed. National Association of Active Investment Managers, all in at the top, right before a pullback. Retail earnings, top 30 weights. Earnings revisions last 60 days, revised up 3.4%, and for next year, up 1.85%. Transport's earnings revision down 13 basis points for this year, up 1.22% for next year. Earnings growth, we talked about that, and kind of the aspects of it that are a bit fugazi with the paper gains, but we'll go from there. We're going to get through the AMAs a lot quicker because we did them manually before, and now we know the answers to the test. Albert Ruddle, looking forward to seeing you at the Money Show in San Francisco. I'll be talking there, I think, the 28th or something, so check that out. I'll put out some promotion on that once I get it. Opinion on Boston Beer Company, not for me. I think the premiumization trend is the right way to go. Any thoughts on Weatherford? Better margins than National Oil Varco, except you missed that move already. National Oil Varco were in for much different reasons than Weatherford. Jasper Jenkins, what platforms do you love? Coifin, Bloomberg, we use them all. The most important thing we use is the SEC EDGAR, and we go to source documents. We don't like secondhand interpretation of the source material. We like to do our own interpretation and analysis. Curious what valuation methods you use the most. It depends on the sector. It depends on the cyclicality of the business. It depends on management. Obviously, DCF, all the basic stuff. But at the end of the day, you could do that with a computer. It just comes down to experience and learning what things matter for each sector, each company, how they're viewed, what they've done historically, and what are you paying for the current cash generation? What are you paying for the future cash generation? And is it a deal? But we're looking for good businesses at great prices during period of dislocation when you're doing the valuation with a crayon, not a scalpel, because your price is so deeply discounted that you have so many outs and so many different ways to win, even if you're wrong. And that's what we look for, is forced selling and opportunities along that lines. Bobby J, asking about value traps. Value traps are just cheap multiples with no clear catalyst for turnaround, no correct jockey. Balance sheet might be in trouble, or people just screening by low multiples thinking they're value investors when they're just bag holders. CNM, distributor for water, wastewater, storm drainage. Gosh, did we do this, Chris? Let's see. I'll tell you in a second. I think this one was a yes. No, this one was not a yes. CNM. Yeah, you missed this one. It's late. We like to buy things down, but welcome to the podcast. Tim D, thoughts on CMG? We cover this every week. It's fine. It's going to work with the restaurant turnaround. Jackson Matthews, a question about value trap again. Again, no catalyst, wrong management, bad balance sheet, trading on multiples versus turnaround story, and understanding the business, whether it's a temporary or permanent impairment. Matthias, Mule, Boston Scientific, no, too early. This is a broken stock. This is when I was pitching my first boss on in 2011, and he wouldn't buy it at $7. 15 bagger later. There we are. And this one was super interesting. Marcus Pitter, Zalando, ZAL. We actually put this on the list to do some work. Good pick there, I think. We got to understand the business a little better. Jason Bailey, Groupon. I think that's a value trap. I know there's a new CEO, but there's no sign of a turnaround in terms of revenue. That business only works during recessions. So yeah, if Trump doesn't end the Iran war, maybe you buy Groupon in the fall, but it's a dog shit business, and there's been no change there. Maybe they have a CEO that can change it, but they've increased the share count so much. That's kind of the definition of a value trap, like a Western Union. ConMed, we liked. That was from Udit A. Next one was Tariq. Been recommending the podcast. How do you get to 150? It's been a D-rated because growth slowed down. Now margins are reaccelerating. Revenue and cash flows are still at and near records. And then God forbid you get some good execution on top of that, you'll start to see multiple expansion again. And if you do the DCF, they brought the share count down dramatically by 30%, and revenues are higher, cash flows higher, and it's just a matter of time. The sector's out of favor. If you saw SoFi today, MasterCard and Visa announced stable coins, which is, kind of just headline noise. And this is a cash machine. If you look at SoFi, they're just losing money nonstop, and anyway, this will be at least 150. It's just a matter of when it's going to determine our IRR. Brady Todaro, securities license, you need a 65. William Bonner, Molson Coors, that's a value trap. I don't think the beer stocks are going to do as well. If you don't want to buy Diageo, buy like Brown-Forman or something and just sit through the volatility until they all turn. Home builder Vistry, this is another one that we put down on our list. That's from Chris Booker. We agree with that one. We're going to do some more work on it. Vistry? Yeah, that's the home builder. Someone sent us a software company, Theo Dujardin. Verix. It's related to tax. I just wanted to make sure that the moat was intact, but worth looking at more, but not something we would invest in. Joey P. Copart, we like. We're doing work on that. Good job. Chris Peach, McCormick, we like that one for the long term. You're going to get paid to wait. Dollar General is fine, but you missed the recovery already. You're late, but it'll still go higher over time. And Alejandro Bustamante, SPX.L, SpearX, we like that one. Good job on that. We're going to do some additional work on it. Daniel Ash, honest take on Seeking Alpha, like quant ratings, factor grades, waste of time in my opinion. With that said, we'll see you next week, same time, same place. Hopefully this one took so I don't have to record it a third time. In the meantime, make it a great one. Bye for now. Pause your video player to review our terms and disclaimer. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Great Hill Capital LLC or PPI is not under any obligation to update or keep current the information contained herein. Great Hill Capital LLC or PPI and its respective officers and associates or clients may have an interest in the securities, derivatives, or entities referred to in this material. Great Hill Capital LLC or PPI accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.